Stop scrolling. Listen carefully because what I'm about to show you could completely rewrite your understanding of silver, gold, and the fragile financial systems built on them. 5 business days. That is the thin line separating a paper illusion from a physical crisis that could rock markets around the world. Right now, 6 million ounces of silver are sitting in limbo on COMEX. Registered vaults are bleeding month after month. The coverage ratio has collapsed to a mere 14.2%, and paper leverage is stretched 7 times beyond what actually exists in physical form. On your screen, it looks calm, controlled, even safe. That is a lie. A carefully orchestrated mirage designed to lull the masses into thinking everything is fine. But the reality is harsh. When April 1st notice day arrives, it isn't just the trajectory of silver that will change, it is the trajectory of confidence in the financial markets for the rest of 2026 that is at stake. Very few people will realize what's coming until it hits, and by then, it will be too late. This is not speculation. This is happening in real time. The numbers are screaming at you, but the headlines are whispering lies. If you think the $70 per ounce on your screen tells the story, you're missing the point entirely. Zoom out just 2 weeks and the volatility is staggering. Early March, silver trades over 87 per ounce. 3 days later, it plunges below 77, dropping more than $3 in a single session. Then March 19 strikes like a hammer from the sky. A one-day crash drops it to 66, 69, only for it to snap back to 72 the next day. These are not ordinary market fluctuations. These are controlled demolitions engineered by forces that manipulate paper contracts while the physical metal quietly disappears. Registered silver has collapsed over 70% since 2021, total COMEX inventory has fallen 31% since October 2025, and much of what remains is already encumbered, pledged as collateral, or under regulatory restrictions. Retail investors see numbers on a screen, and they nod, thinking the system is normal. But behind the curtain, the story is one of scarcity, pressure, and a market quietly being drained to its skeleton. JP Morgan has been quietly orchestrating this storm for years. They paid $920 million in fines for spoofing and market manipulation between 2008 and 2016. Traders went to federal prison. And yet today, they hold an estimated 750 million ounces of physical silver, more than enough to move the market in any direction at any time. Hundreds of thousands of fake orders were placed over nearly a decade to deceive participants, and now that hoard sits like a sleeping giant, waiting for a moment to assert control. Retail traders are margin called forced to liquidate positions or trapped with paper claims, while JP Morgan has the ability to suppress prices, drive rallies, or simply sit on the metal and watch chaos unfold. Mainstream financial media barely acknowledges this. Most investors don't even know it exists. They are blind to the real force moving markets from behind the curtain. Across the Pacific, China has just turned silver into a strategic weapon. A new export licensing regime limits silver exports to only 44 approved companies, shutting hundreds of smaller suppliers out completely. China controls 60 to 70% of the world's refined silver supply, and even partial restrictions create immediate global supply shocks. Industries relying on silver, EV batteries, solar panels, semiconductors, AI data centers, advanced medical devices, are staring down skyrocketing costs and potential shortages. This is no longer a commodity market. This is geopolitics dressed in finance. If you thought the rare earth export controls in 2010 were disruptive, this is the silver equivalent, surgical, strategic, and capable of sending entire industries scrambling. Elon Musk has publicly warned that industrial silver shortages could halt production. This isn't fear-mongering, this is policy colliding with an already stretched market, and the consequences could be catastrophic for anyone not positioned correctly. Energy shocks are compounding the crisis. Missile strikes on Qatar's industrial hubs, combined with the closure of the Strait of Hormuz, have sent Brent crude surging above 130 per barrel. Industries consuming massive amounts of silver, particularly solar panel manufacturing and semiconductor fabrication, now face sharply higher input costs. The Federal Reserve has indicated only one potential rate cut for the rest of 2026. Real yields are climbing. The dollar is strengthening. Silver, which does not generate yield, suddenly becomes expensive for institutions to carry. They are selling not because the fundamentals have changed, but because holding a non-yielding asset has just become cost prohibitive. The chaos you see on your charts is not random market behavior, it is forced liquidation engineered by the interplay of energy shocks, regulatory timing, and margin hikes. The system is stressed, fragile, and dangerously close to breaking. Physical premiums tell a story the paper markets refuse to acknowledge. In Japan and the UAE, physical silver is trading at 130 per ounce while COMEX spot sits at 72 and 80% premium. Shanghai Gold Exchange premiums have surged 12 to 13% above benchmarks. The divergence is brutal and deadly for anyone relying on paper contracts without physical delivery. Recently, 44 silver trading firms in India collapsed, with combined liabilities approaching $425 million. Why? They were holding paper, not real silver. When margins were called, they crumbled within hours. Retail investors watching price charts and headlines were oblivious to the structural truth. The paper market is a mirage, and every day it persists, the danger grows exponentially. 5 business days remain until April 1st notice day. That countdown is ticking louder than any chart could ever show. With only 2% coverage and leverage 7 times higher than physical availability, even a minor disruption could render COMEX paper prices irrelevant. The physical market would dictate reality, exposing those relying on paper contracts. China's 44 approved exporters may continue shipping, but one hiccup, one delay, and the carefully maintained illusion could collapse in hours. Headlines will say silver fell 45% since January highs, and retail traders will breathe a sigh of relief, thinking the trade is over. But you know better. You've seen the vault data, the Shanghai premiums, JP Morgan's massive holdings. You understand the structural deficit that has persisted for 6 consecutive years, the invisible pressure building silently beneath the surface. The global silver supply deficit since 2021 stands at roughly 20 million ounces, nearly a full year of global mine production erased from the system. Total mine output has plateaued since 2016, with no significant increases expected even in the face of record prices. Global demand hit 24 billion ounces in 2025, while total supply was only 101 billion, leaving a 230 million ounce gap. London vault holdings have lost roughly 40%. Shanghai inventories have plummeted to just 450 tons, a 91% decline from the 5280 ton peak in 2020. The smart money is quietly accumulating. Sprott Physical Silver Trust alone raised $2 billion in January 2026, absorbing 18 million ounces, roughly 16% of COMEX registered vaults. Meanwhile, ETFs bleed, margins are being called, and paper traders are oblivious to the crisis unfolding behind the scenes. The market is on a knife edge. Every day that passes brings the system closer to a tipping point. The interaction of geopolitics, energy shocks, regulatory changes, and physical scarcity creates a perfect storm. Retail traders are caught in the eye of it, lulled by screens and headlines, while institutional players quietly adjust, position, and prepare. The narrative you see in financial news is carefully curated, designed to mislead, to keep masses calm while the underlying reality spirals toward a potential delivery crisis. 5 days.